$500,000. You just crossed it. Or you're close enough that you're watching videos like this one. And here's the thing, the financial world just changed how it sees you without telling you. The threshold doesn't just change your net worth statement. It changes who comes after you, which rules apply to you, and most importantly, which risks suddenly exist that didn't matter before. Before you celebrate, there are 4 specific dynamics that kick in the second that number rolls over, and one of them has already wiped out early retirees who had more than double what you have right now. Let me tell you what actually happens. Most retirement content treats $500,000 like a finish line. Max your 401k, invest consistently, hit the number, sunset on a beach. That story is incomplete. And incomplete in this context means you might run out of money. Not because you were reckless, because the game has different mechanics at this level, and the standard advice was never designed for them. I'm going to walk you through 4 shifts that most retirement calculators don't model, and most financial advisors have a financial incentive not to explain clearly. Before I do, let me introduce you to the metaphor I'll use through this whole video: critical mass. In physics, critical mass is the minimum amount of fissile material needed for a nuclear chain reaction to become self-sustaining. Below it, nothing special happens. You just have radioactive material sitting there. But the second you cross that threshold, the reaction changes character entirely. The same forces that were passive become active. The same material that was inert becomes something completely different. $500,000 is your critical mass. Below it, your portfolio is accumulating. Above it, it starts chain reacting, and some of those reactions are magnificent, and some will eat you alive if you don't understand what just changed. The chain reaction has started. Some of it is working for you. But first, I want to show you something that starts working against you at exactly this number, something that happens before you even touch your portfolio. There's a reason the financial services industry uses the phrase high net worth individual with a cutoff somewhere around $250,000 to $500,000. Because that's when you become genuinely worth the cost of acquisition. A financial advisor managing your assets at 1% per year earns $5,000 annually on a $500,000 portfolio. That's a viable business relationship. Below that, not really. So the moment you cross this number, the volume of outreach, the seminars, the free consultations, the concerned phone calls from the advisor your company recommended, it increases. Not because your needs changed, because your balance sheet crossed a profitability threshold for them. This is not conspiracy, it's just incentive math. Here is where it gets really interesting. That 1% fee, which sounds reasonable, is not a one-time cost. It compounds against you. A seemingly small 1% difference in annual fees can reduce your final portfolio value by 20 to 30% over 30 years. On a $500,000 starting balance, growing at 7% annually for 30 years, you'd have roughly $3,800,000 with no advisor fee. Drop that growth rate by 1% because your advisor is charging you 1% annually, you land at approximately $2,870,000. The difference is about $930,000, not over your lifetime, just from 1%. And it gets worse. 2 percentage points of annual fees, a 1% advisor fee, plus 1% in actively managed fund fees, compounded across 4 decades, can turn a $7.2 million retirement into a $3.9 million retirement. That is roughly half the eventual portfolio, vaporized by a charge most clients accept as the normal price of doing business. Why do people accept it? Because the fee is invisible. It doesn't come out of your account in an obvious line item you approve each month. It just quietly drags your return from 7% down to 6%. And you never see the $900,000 that never existed. You can't grieve a ghost. Now, you might be thinking, sure, but a good advisor adds value that offsets the fee. And some do. The ones who do tax optimization, estate planning, behavioral coaching, there's a real case for them. But here's the catch. The people positioned to reach you aggressively, right as you cross $500,000, are not usually those people. They're usually salespeople with fiduciary sounding language. Just 21% of active strategies survived and beat their index counterparts over the 10 years through June 2025, according to Morningstar. Not 21% of sketchy funds, 21% of all of them. Over the 20-year period from 2005 through 2024, 94.1% of all domestic funds underperformed the S&P 1500 Composite Index. When someone shows you an actively managed fund charging 1.5% annually, they are selling you a product with a roughly 6% historical chance of outperforming a basic index fund over 2 decades. And charging you for it. That is not investing. That is a subscription to an expensive coin flip. The solution at the $500,000 threshold is not to avoid advice. It's to understand the difference between advice you pay for directly, a flat fee fiduciary, a fee-only certified financial planner, versus advice that's paid for by a percentage of your assets, where the advisor's income grows automatically as your wealth grows, regardless of what they do for it. Those are very different relationships. One is a doctor. One is a pharmacist with a commission. Stay with me, because what I'm about to show you is the part where even people who handle the advisor problem perfectly still get blindsided. The number that's been dominating retirement planning for 30 years is actively misleading people in 2026. And the way it misleads them is subtle enough that I'm still annoyed by it. The 4% rule, you know it. Withdraw 4% of your portfolio in year 1. Adjust for inflation each subsequent year. $500,000 at 4% is $20,000 annually. Add Social Security, and for many households, that math works on paper. But here's the setup you need to know. The 4% rule was developed in the 90s by financial planner William Bengen based on historical US market data. Back then, bonds paid around 6 to 7%. Inflation was tame, and life expectancy was shorter. Under those conditions, a 50-50 stock bond portfolio could reliably sustain 30 years of withdrawals. People are now living longer, meaning your portfolio may need to last 35 to 40 years, not 30. The foundational assumption of the rule the 30-year horizon is increasingly wrong, and the bond component that gave the rule its stability is different now. The math changed. The rule didn't update on your behalf. Here is the wrinkle inside the wrinkle. The rule's own creator no longer endorses it, as most people use it. Bengen himself has since revised the figure upward, most recently suggesting 4.7% as the worst-case historical safe withdrawal rate. He told CNBC in 2025 that retirees who stick with just 4% are likely cheating themselves a little bit of the retirement they earned. So the rule is, simultaneously, too conservative for some people and too aggressive for others. And the correct answer depends on things no retirement calculator you've ever used accounts for properly. Things like the specific sequence of market returns you experience in your first decade of withdrawals, your actual healthcare costs before Medicare, and how much of your spending is fixed versus flexible. The 4% rule is a blunt instrument, and at $500,000, blunt instruments will cost you. You think the problem is picking the right withdrawal rate, but actually the problem is that a fixed withdrawal rate is the wrong framework entirely. The right model is a dynamic one, where your withdrawal rate adjusts based on what the market is doing. In a strong year, you pull slightly more. In a down year, you pull slightly less, preserving principal during the critical early phase. Even pulling 3.5% instead of 4% during a bear market can meaningfully extend portfolio longevity. The 4% rule assumes you're going to withdraw the same inflation-adjusted amount every single year, regardless of market conditions. Nobody actually lives that way. By the way, hit subscribe if you like what you're hearing. Otherwise, YouTube's algorithm may never show you my videos again. Here is the part that never makes it into a retirement calculator. I sat down with 50 years of retirement data, sequence of returns, research, healthcare cost modeling, Social Security timing analysis, tax drag data, and I built a framework I call the Exit Code. It is a digital book, 8 chapters, no filler, built around one question. What does the math actually say about leaving the workforce early, safely, and permanently? There are 2 things in particular that connect directly to what we're talking about right now. The first is what I call the 4% trap. Not a criticism of the rule itself, but a diagnostic for why fixed withdrawal thinking destroys otherwise healthy portfolios in their first decade. I built a dynamic withdrawal method around 50 years of market data that replaces the static 4% with a logic-based range. The second is something I call the lazy portfolio, a construction that has historically outperformed the average active trader over any 30-year window in the dataset. Not because it's clever, because it's boring, cheap, and doesn't pay anyone a percentage of your compounding. You can get the exit code for less than dinner out for 2 through the link in the description. Every year you spend with the wrong withdrawal model compounds against you. Now, back to the actual problem. Here's something most retirement planning advice handles badly. What happens between the day you stop working and the day Medicare starts? This is not a small problem. It is a 5-figure annual problem that hits right when your savings are most vulnerable. Medicare begins at 65. Most people who retire with $500,000 and do the math correctly are targeting somewhere between 58 and 65 as their exit window. That gap between when you stop working and when Medicare kicks in is what I call the insurance ambush. And in 2026, it just got significantly worse. At the end of 2025, the enhanced premium tax credits that had lowered ACA premiums since 2021 expired and were not renewed for 2026. For early retirees, this means the subsidy cliff at 400% of the federal poverty level is back. So anyone earning above roughly $62,600 as a single person in 2026 pays full price for marketplace coverage, which can exceed $1,500 a month at age 62 in some rating areas. Think about that for a second. If you have $500,000 invested and you're drawing from it to live, your income is above that subsidy threshold, which means you pay full freight for health insurance for one person. At $1,500 a month, that's $18,000 a year, and that's just the premium. Before deductibles, co-payments, prescriptions, paying about $12,000 to $13,000 per year in premiums per person can consume a notable portion of annual retirement income, particularly for households relying on withdrawals from savings or investments. And remember, that's before we get to the long game. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs, not including long-term care, which, incidentally, can range from roughly $50,000 per year for home care to more than $110,000 per year for nursing home care. I know someone, a careful, diligent saver who retired at 62 with $600,000 invested. Felt great. He'd modeled out his spending, identified a reasonable withdrawal rate, and felt genuinely confident about the plan. What his spreadsheet didn't have was a column called Insurance Before Medicare. His first year, he spent $23,000 on health coverage, not on medical care, on insurance premiums and cost sharing. That was 40% of his planned annual withdrawal. His 4-year gap to Medicare cost him roughly $90,000 in insurance costs alone. Out of a $600,000 portfolio, 15% of his nest egg gone before Medicare even started, just to stay insured. This isn't an edge case. It's the rule. And the $500,000 crowd is exactly the group that gets hit hardest by it, because they have too much to qualify for most subsidies and not enough buffer to absorb it without adjusting the plan. Let me show you the 3-level structure of this problem. Level 1, the premium itself. Level 2, the out-of-pocket cost the premium doesn't cover deductibles and co-pays that reset every January and can easily add $6,000 to $10,000 in a difficult health year. Level 3, the compounding cost of withdrawing extra money to cover healthcare, which means selling shares earlier than planned, which means less principal benefiting from future market growth. It's a triple hit. The insurance costs money. Paying for insurance with portfolio withdrawals costs compounding. And the years before Medicare are often when sequence of returns risk is highest. Which brings us to the fourth thing that changes at $500,000. And this one has ended retirements that looked mathematically bulletproof on paper. Consider 2 people, same age, same portfolio size. Both have $500,000 saved. Both retire in the same calendar year. Both average the same 7% annual return over 30 years. One of them runs out of money. The other leaves behind an estate. What's the difference? The sequence of returns. not the average, the order. According to a recent report from Fidelity, if a retiree starts with a balance of $1 million and withdraws $50,000 each year, and there's a sequence of positive returns early in retirement followed by a bear market later on, the portfolio will have a balance of more than $3 million after 30 years. On the other hand, if there are negative returns early in retirement followed by a bull market, the portfolio would be depleted in 27 years. Same average return, same withdrawal amount, different order of returns. One ends with $3 million, one goes broke in 27 years. This is not a niche academic scenario. If a 65-year-old retired around 1972, right ahead of them was the 1973 to 1974 bear market, when the S&P dropped 48%. That was a time when you had really high inflation, we had an oil crisis, and we had a lot of political instability. The people who retired in 1968 looked at the people who retired in 1973 and saw mirror image outcomes from nearly identical starting conditions. Here's the mechanism. When the market drops in your first few years of retirement and you're still making withdrawals to live on, you are selling shares at their cheapest price. You're locking in losses. The portfolio can't recover the way it would during accumulation because you're taking money out while prices are low. Even if the average annual return over time is favorable, early losses can compound the problem because withdrawals lock in those losses, leaving less capital to benefit from future gains. This is why the first decade of retirement is called the critical window. The crucial sequence timing is the first decade or so, where the correlation peaks between real returns and safe withdrawal rates. Your portfolio at $500,000 is both large enough to matter and not yet large enough to absorb a severe early sequence of bad returns without serious structural damage to the plan. And here's the thing people miss. You can't predict the sequence. You can't time the market out of it. Retiring 6 months earlier or later might mean the difference between a good sequence and a catastrophic one, and you'll never know until you're 5 years in. Retirement timing is pure luck of the draw. Retiring on the eve of a monster bull market versus just before a gut-wrenching crash can mean wildly different futures for two people with identical plans. But you can prepare the architecture of your portfolio to absorb it. The solution isn't predicting the market. It's building a withdrawal structure that doesn't force you to sell equities during a crash. Cash buffers, bucket strategies, dynamic withdrawal rates. These aren't exotic instruments. They're just the engineering that protects you from the randomness you can't control. There is, by the way, one government income stream. That sequence of returns cannot touch Social Security. The benefit doesn't drop in a bear market. It doesn't lose principal. It's indexed to inflation through cost of living adjustments. And most people are leaving enormous amounts of it on the table. Retired workers born in 1960 or later can increase their benefit 77% by simply claiming Social Security at age 70 rather than age 62. 77%. That is not a small difference. The average 70-year-old retired worker receives $2,188 per month in Social Security benefits. The average 62-year-old retired worker receives $1,377 per month. $811 a month, multiplied by 12 months, multiplied by however many years you live past your break-even point. The compounding value of delaying Social Security is one of the most reliable, risk-free investment decisions available to you. And last year, more than 20% of newly awarded retired workers claimed Social Security as soon as possible at age 62, getting the smallest possible benefit. Meanwhile, less than 10% delayed until age 70. The people delaying to 70 are using their portfolio to bridge the gap. They're drawing down slightly faster in their early 60s while letting Social Security compound. They're exchanging temporary portfolio drawdown for a permanent, inflation-adjusted income boost that sequence of returns cannot touch. That is a strategy, not a gamble. And almost nobody does it. Now, here's where I want to walk you through a realistic version of what this all looks like together. Not a hypothetical high earner, an actual realistic scenario. Meet Marcus, 47 years old. works in project management, household income around $110,000 a year. He has just hit $500,000 in his 401k and a Roth IRA combined. He has no pension, he has a paid-off car, and roughly 3 years of expenses in liquid savings. He wants to retire at 62. Marcus runs the numbers. At 4% withdrawal on $500,000, he gets $20,000 annually from his portfolio. Social Security at 62 would add maybe $14,000 a year based on his earnings record. Together, that's $34,000 annually. His target spending is around $58,000 a year. On paper, he's short $24,000 a year, so he needs to grow the portfolio. 15 years of growth at 7% annually with continued annual contributions of $15,000. Marcus's $500,000 grows to somewhere around $2 million by 62. At 4%, that's $80,000 annually, plus Social Security. The math starts working. Except, Marcus is not accounting for 4 things we just covered. Number 1, if he starts working with a 1% AUM advisor at age 47, that drag reduces his 7% growth to roughly 6%. Over 15 years, the difference between 7% and 6% on his current balance alone before contributions is approximately $300,000. He effectively pays the advisor with future portfolio value he never sees on a statement. Number 2, when Marcus hits 62 and retires 3 years before Medicare, he will face health insurance premiums of roughly $15,000 to $18,000 per year minimum. Given that the ACA subsidies expired in 2025 and his portfolio income keeps him above subsidy thresholds, over 3 years, $50,000. That's $50,000 in additional withdrawals before Medicare kicks in, which means selling shares potentially during a market downturn, which is exactly when you don't want to be selling. Number 3, if the market drops 25% in Marcus's first 2 years of retirement, totally normal historical behavior, and he's still withdrawing to live on, the recovery math for his portfolio changes permanently. The same $2 million portfolio hit by an early bear market may sustain only 25 years of withdrawals instead of 35. Number 4, by claiming Social Security at 62 instead of waiting until 70, Marcus permanently locks in a benefit that is roughly 70% of what he would have received at full retirement age, and roughly 45% of what he would get at 70. That's not a temporary reduction. It follows him for life. None of these are catastrophic individually, but they compound, they interact. And the average retirement planner, the one charging 1% of his assets, is not incentivized to model them together in a way that might convince Marcus to manage his own money. Let's run the numbers on the Social Security piece specifically. If Marcus's full retirement age benefit is $3,000 a month, and he claims at 62, he gets roughly $2,100 a month. If he waits to 70, he gets roughly $3,700 a month. Over a 20-year retirement, the difference is 60 months times $1,600 per month. For years 62 through 70, that's $96,000 in benefits he gave up by claiming early. After break even around age 80, every additional year at the higher amount is pure gain. If Marcus lives to 87, which the Social Security Administration says is statistically reasonable for a 62-year-old man today, the delayed claim strategy generates approximately $170,000 more in lifetime benefits. Tax advantaged, inflation adjusted, sequence of returns, proof income. The irony is that the people who claim early often do it because they're worried about running out of portfolio money. The Social Security bridge strategy turns that logic around. Use a little more portfolio money in years 63 through 70 to fund your living expenses, specifically so you don't lock in a reduced Social Security benefit permanently. You're trading a temporary portfolio draw for a permanent income boost that outlives any market cycle. And here's what that means in terms of sequence risk. A higher guaranteed Social Security income means you need smaller portfolio withdrawals to fund your lifestyle in old age. Smaller withdrawals during a potential bad market sequence means you sell fewer shares at low prices. The Social Security delay strategy is, among other things, a hedge against sequence of returns risk. That's the kicker. 3 things to do now, whether you're at $500,000 or still building toward it. First, audit every fee you're paying, not just your advisor's percentage, the underlying fund expense ratios too. If your total all-in cost is above 1% annually, calculate what that difference costs you over 30 years using your current balance as the starting point. A lot of people make this calculation once and immediately move their assets to a low-cost index fund approach. The math is not subtle. Second, build a specific pre-Medicare healthcare budget, not a vague healthcare contingency. If you plan to retire before 65, price out actual marketplace plans in your state for a person your current age. Assume no subsidies because the enhanced credits expired in 2025 and their future is uncertain. Build that number into your retirement income requirement before you decide you're ready. Third, run your Social Security break-even analysis using the actual numbers from your SSA statement. Log into ssa.gov, get your real benefit estimate at 62, at full retirement age, and at 70. Calculate when the higher delayed amount surpasses the cumulative value of the early amount. If your break-even is around age 82 and you have any reason to expect you might live past that healthy family history, no major chronic conditions, the delay strategy is worth serious consideration. Critical mass has been reached. The reaction is running. The question is whether you've designed the containment structure or whether you're just hoping the chain reaction stays manageable on its own. Lazy investing built more fortune than crypto memes. The second you start letting fees, fixed withdrawal rules, and unmodeled healthcare costs manage your portfolio for you, you've outsourced your retirement to people with different incentives than yours. Is less than sight is greater than sources. Empower Personal Dashboard, March 2026. Kiplinger, April 2026. Bankrate 2025 Retirement Savings Survey. NerdWallet Federal Reserve Survey data. CNBC December 2025 on 4% rule. Spiva Scorecard year-end 2025. Morningstar September 2025. Fidelity Investments 2025. Retiree Healthcare Cost Estimate, Bolden.com, March 2025. Charles Schwab Social Security Guide, May 2026. Kiplinger Social Security, March 2026. CNBC SORA, April 2026. Is less than, sight is greater than. Total word count to 5,300 words. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. And yet, the average retirement savings for all American families is $333,940, with a median of $87,000. Only 5% of households with retirement accounts have $1 million or more saved. $500,000 puts you in a genuinely rare position. If you're saving at all, you're doing better than the majority of Americans. 54% of American households reported having no dedicated retirement savings. That matters, but it also makes you a target for every dynamic I just described. The advisor fee machine, the outdated withdrawal rule, the healthcare gap nobody prices in, the sequence risk nobody can predict, but everyone can prepare for. The chain reaction started the moment you cross critical mass. Make sure it's working for you.